Hello and welcome to Chapter 13. In this particular Chapter 13, we're making a big change from what we've done so far. Congratulations to you guys that are MBA students, because this next part of this is really going to talk more about accounting for internal users as opposed to external users. We're taking a major shift. We are done dealing with debits and credits, and we're going to talk specifically about how you apply some of the things that come out of accounting systems to make decisions within an organization. The big thing here is we're going to talk, so we're shifting to something called managerial accounting and how you use that information to make decisions within an organization. So what we're going to do, our learning objectives for this particular chapter, we're going to understand the meaning of managerial accounting and compare and contrast it to what financial accounting is. We're going to look at the current focus of management accountants and managerial accounting in an organization. What are costs and different types of costs that businesses have and how they're assigned to products and services, and what we do with these and that sort of stuff. And then we're going to prepare an income statement for manufacturing and service organizations. And we're going to talk about ethical behavior and also certification for managerial accountants. A managerial accountant, it's different than financial accounting in the sense that managerial accountants provide information to internal users, really decision makers. And if you would think about it, both accountants are really scorekeepers for a business. Managerial accountants are predominantly responsible for keeping score within the business, and external and financial accountants are for external. And financial accountants are going to be concerned with GAAP, whereas managerial accountants are going to provide reporting and analysis based off of the needs of the organization and whoever the management is at that particular time. And it may shift. And this is a lot more analytical than financial accounting. It's a little bit more fun, quite candidly. And what they're looking at is if you had taken a management class, it would be planning, controlling, and directing an organization. That's what this stuff is all about, and that's what managerial accountants do. Planning, controlling, and decision making within an organization. They provide those decision analysis so that managers can make decisions to improve the profitability of an organization. Um, and so that's the key responsibility of a management account. So let's talk about each one of those just a little bit. Planning. Planning says, what are we going to do? How are we going to proceed to make profits within our organization? And part of planning also has to do with coordination of activities between, say, sales and operations and management and finance, because each one of those are different as far as how they're going to run their organization. So planning is one of the roles of management accountant. And so a simple example, we want to improve quality. So they might do a supplier evaluation program, and management accountants are going to keep track of that stuff and report back to management what they find. The next one is controlling. And here it says actual performance and expected performance. I would say budget versus actual, but not just the comparison, but understanding why and the drivers of why they're different. Was the budget wrong? Were the expenses wrong? What happened within the organization that they're comparing these two, and what can be done differently? And typically, this is going to happen on a month-to-month basis within an organization. Sometimes it'll happen just at the organizational level, at like a low-level part of the organization, but more often than not, it's going to have a higher level view for the organization. So that's controlling. And the last one is decision making. And decision making can take several different forms. Let's say between two alternatives. So for us in the real world, what we might look at is, do I want to buy a new car or not? And you look at the financial implications and the quality. So that's the quantitative stuff, the numbers, but you also look at qualitative stuff like driving a new car makes you feel good. It smells good. There's things that you really like when you are associated with having a new car. That's decision making within an organization, and managerial accountants work to quantify and maybe also quantify and qualify to make certain I'm clear what they should do as an organization. So we touched on this a little bit ago. Financial accounting is responsible for stuff for external users. So really, their primary responsibility are the four financial statements and any associated schedules. The four financial statements we just finished. Remember, we just finished the statement of cash flows, but it's also the income statement, statement of retained earnings, and balance sheet, and any associated schedules. And they're more responsible for historical stuff and understanding what's happening within the organization And for external, the key you want to look at is financial accounting and external are the key words here. So it's investors, creditors, customers, suppliers, government agencies, unions, etc. That you want to take a look at. And that's what financial accounting does. Managerial accounting, by the reverse, deals with internal stuff to the organization, what happens within the organization, how the organization operates, and how they make their money. Think of it this way: if you are looking at Lowe's, if you're a financial accountant at Lowe's, you would be concerned with how much money did they make last quarter or last year. Where if you're a managerial accountant, you might want to look at what did each region for Lowe's. Let's say Lowe's is broken up into three regions in the United States. They might say, what region made the most last year? What was the budget for each region last year? What was the budget? It might even say, well, I want to look at the budget for each one of the garden centers at Lowe's. And do we need to make decisions about doing something different within those garden centers? That's kind of the difference. Remember, internal and external. So here's kind of a summary. You can pause on this and read through this. I'm not going to read it, but you can kind of take a look. The thing that's probably the most interesting is this down here. So if you're trying to figure out, and many of you guys will not be accountants, I understand that, but if you're trying to figure out what you want to do accounting wise, the majority of you are probably going to be in here on managerial if you're going to work in industry within a company, say Kimberly Clark or Dean Foods or some other Dr. Pepper, PepsiCo, or any of those, you're going to probably work in managerial accounting. Financial accounting, if you work in industry, is still going to be primarily focused in on the financial statements and auditing the financial statements and making certain that they're right and following rules. And this one's a lot more enjoyable to me, and I think you can add value to the business. This one, the financial stuff, you might be expected to be in an office all the time. This, you might get to travel and be in manufacturing facilities and the sort of stuff. So it's kind of different and it's broad. So you can deal with sales and operations, depending upon what your focus is and what it costs you to, and you might also look at what it costs you to produce a product, for example. So what's the difference? The difference is accounting system has to be flexible enough to manage both systems for both. You want to provide enough summary information to provide for external reporting, but detailed information so you can analyze to a low enough level to make operating decisions within the organization. And typically, that gets accomplished with at least larger organizations with something called an ERP system, which stands for Enterprise Resource Planning Systems. With the current focus of managerial accounting has changed over time. Um, Managerial accounting systems change to provide information for planning, controlling, and decision making, which is what we talked about. But there's new methods that we're taking a look at, and that particularly has to do with how you figure out what it costs you to make a product, what your customer profitability is, looking at cross functional, so across different functions within an organization, and looking at total quality. So what they're really talking about here is there's been several different initiatives that management accountants have been expected to support over time. And some of you guys who might be associated with these in your businesses, like total quality management might be one, balanced scorecard might be another. Another one is just in time. And finally, something called activity-based costing, which is a little bit different than traditional costing. And it's really a function of how they allocate a bucket called manufacturing overhead or overhead depending upon if you're a service organization or a manufacturing company. Those are all different initiatives in management accounting or managerial accounting. So one of the new methods, and I touched on this a little bit, is something called activity-based costing. To understand the difference between activity-based costing and traditional-based costing, there's really three primary items or three costing items that are associated with product cost. Product cost or service cost. There's direct cost, can include direct materials, which you can physically attribute to a product, direct materials, direct labor, and then you have manufacturing overhead or just overhead if it's a service company. Well, what happens is activity-based costing in traditional costing, they would only use one driver, say in a facility, maybe pounds or units produced as the driver. But in activity-based costing, they look at how much activity it takes to make a given product in order to allocate the overhead. So what we're really focusing in on is the overhead. We're not focusing in on the direct materials or the direct labor. We're focusing in on overhead. That's what activity-based costing is all about. And it was developed in the late 1980s. And it really was a shift in the paradigm in costing products and services. And it looks at value add and it looks at ways to improve to reduce product costs based off of the cost drivers for each organization. A customer orientation, you want to look at profitability and what happens with customers. You might say the best thing might be, a simple example. You might think the best thing is to get a sale with Walmart. But when you start looking back at what it really costs you to service Walmart, maybe it's not a good thing to have a sale with Walmart, because if you do, there's a lot more stuff that goes into servicing that customer where, well, you could make 5 sales to different retailers. Say if you're a food processor, that might be a better sale than what you had to Walmart, because Walmart demands so much of your time and efforts that it really costs you more. So this customer orientation. Then strategic positioning is one where you're talking about what you're really doing as a business. Are you a low cost leader? I mean, if that's what your thing is, or are you better creating a differentiated product? So you can look at differentiated products you say, what do you mean by differentiated products? Well, maybe you have products that are completely different than what somebody makes in the market. Maybe it's an automobile, maybe it's the Tesla automobile. It's completely different than anything you see on the market, and that's how they differentiate themselves from their competitors. And you're doing as a cost or as a managerial accountant, you're supporting an organization with any of these initiatives to make certain you know what's going on. Value chain is from the point in time that you design the product till you deliver it to the customer. And you might do analysis at any stage in this value chain to determine if you can take costs out or you can do things differently, and how you distribute the product. That's value chain analysis for and you want to minimize your cost through the value chain with maximizing your customer service if you're to kind of draw a parallel. And so that's what value chain analysis is all about. Cross-functional is similar to the value chain, but you're looking at all the different costs that are associated with making the product and the distribution of the product and the sales and service and all the other things that are a function of selling the product. And then this last one is something from Crosby called total quality management. And they came up with a concept underneath total quality management called zero defects. I worked in an organization that we had something called the zero defect day, and you can even see it here. And this was probably from the mid 90s was when this really came about in organizations. The whole purpose of this is continuous improvement. And a lot of organizations might have graphs. If you go into a manufacturing organization, they might have graphs tracking certain things that they're trying to improve based off of the metrics within that business. So remember, we're going back to managerial accounting. So it's all real internally focused and things that they can do that ultimately sum up to a lower cost or higher quality. That's what they're really trying to drive here. A little bit more about total quality management. The most recent innovation in total quality management is lean accounting, which looks at costs within the value chain. And then the most recent one is something called enterprise risk management. And it's a formal way for management accountants to respond to the threats in the organization. Sometimes you might also hear the term called sustainability accounting, and managerial accountants provide support for that. So, what's the role here? The role of a managerial accountant is to support the organization in making decisions with internal reporting. And it's not necessarily standardized internal reporting, but internal reporting. And that's what managerial accountants are all about. And you may not have a seat at the table for the decision making, but you can sure lead people in a direction you want them to go based off of your analysis. So if you really like doing analysis and you like to try and drive business profitability, being a managerial accountant's not so bad. And if you're in any other capacity besides managerial accounting or accounting in general, say a salesperson or production person, you are going to get touched by a managerial accountant. So what they do, one of the things that managerial accountants look at is cost. What it costs to make stuff, what are costs that it takes you to deliver a product or a service, to build, to deliver, that sort of stuff. And we're going to talk just a little bit about different types of costs. And this might be a little bit confusing, but costs are expired when you generate revenue. On the income statement, the revenues was called on the income statement, expenses are deducted from revenues to determine income or profit. Let's look a little bit closer at the price and that sort of stuff and what happens. So costs, accumulated costs, you have a phone bill, and you have these other things that are going to go to the balance sheet. Then you're going to assign these costs to a cost object. And I if you will, the cost, and a phone bill is going to be an overhead item, by the way, but a cost object might be a product, an individual product. Maybe it's a lamp that this organization makes. Maybe it's picture frames. The one on the bottom, support and selling the product, might be another thing. So these are, you're going to assign those. And you notice here it says a cost object is any item such as a product or customer, department, etc., where you can measure and assign costs. Assigning costs to cost objects can do it in a number of ways, such as the need for, and it's really dependent upon accuracy. And typically, what you're talking about here is traditional costing versus activity based costing. And organizations will look at what makes the most sense for them administratively, and also if they really need to have super accurate costs and what it really means to have super accurate costs. So you have direct costs. Direct costs are things that you can specifically identify and physically observe within a product. And the two examples of direct costs that I think are really important for you to look at in the primary examples are direct materials and direct labor. And direct materials, and let me touch on this just for a minute. Direct materials are things such as wood, such as picture frames, glass. If you're making a door, a screen door, it's going to be the screening. It might be the handle. It might be some of those kind of things. Those are all or direct costs that are associated with it. And the person that is making that door is also going to be considered direct costs or direct labor. You have indirect costs that you can't specifically identify to that door, which is our cost object, and they have to be allocated back to that door. And there's no direct relationship between those. You just have to figure out a way to allocate or assign them. So indirect costs, so you have them also in the service businesses, but they're a little bit more difficult. And those are going to be called overhead costs to support stuff. So you can see here that you have direct costs and then you have indirect costs that are allocated. And this where there's other costing categories. You have variable cost and fixed cost. Variable cost stay the same on a per unit basis, no matter what, whereas fixed costs fall on a per unit basis. As each successive unit you produce, the fixed costs go down on a per unit basis, whereas variable costs remain constant. And if you want to think about this isn't exactly correct, but if you think about it this way, you would put direct materials and direct labor and variable costs, and really manufacturing overhead at fixed costs. Opportunity costs are costs that you give up or sacrifice when one alternative is chosen over another. And that's a little bit different than these other two, and you don't generally measure that within what it costs you to deliver a service or deliver a service or manufacture a product. But opportunity cost for you as students, you have an opportunity cost when you come to school or you elect to go to the university. Your opportunity cost is what money you could have made and what you're spending. Your opportunity cost is the income you gave up to go to the university. That's an opportunity cost for you. So product cost is the next part. Products are produced by converting raw materials or direct materials using the use of labor, direct labor and indirect manufacturing resources. So here's some examples. I don't like hamburgers. I don't really care for televisions, automobiles, computers, clothes, and furniture are all examples of things that are products that you might make. Services, you can do service. You have kind of service costs as well. Car rental, video rental, skiing are examples of services that an organization provides. Services are not tangible. Services are perishable, which means they go away. And services require direct contact between the providers and the buyers. And what we want to do, what managerial accountants do, is we must provide cost on how to do those services. And when we get to the next chapters, we'll take a look a little bit more at that. But what it costs to make that stuff and how we want to price it. There's one major exception when we provide costing information. You have to follow external rules when you're inventorying stuff. In other words, when you're putting stuff on the balance sheet, you have to figure out what it costs you and what the cost accumulation is for those items before you put them on the balance sheet. And you have to follow generally accepted accounting principles. And here you have manufacturing costs are those both direct and indirect. So think of this as direct materials and direct labor, and manufacturing overhead. Of producing and manufacturing overhead is anything that you cannot specifically associate with the product. By producing a product in a manufacturing firm and preparing it for sale. And really it's the only thing that's in the value chain, which means that it's costs that can only be moved from you to the customer. And the value chain, remember, is from the time you get the raw material to when the product is delivered to the customer. Those are all costs that you could have. They're generally added to the inventory account, and then they transfer to cost of goods sold when they are out. And you can look at them: direct materials, direct labor, manufacturing overhead, which we touched on. So there's the same thing: product cost. Here they show how they made a Jeep. Okay, the materials, the labor, and the overhead. Direct materials we already touched on multiple times. Physically identified in the product. Direct labor, people that touch or manipulate the materials into something else. It can also have indirect labor costs, and they're going to be an overhead. And this might be a supervisor that is over multiple lines, and he never really touches the product, but he is also labor. But this indirect labor cost would actually roll up under manufacturing overhead in an organization. And so, even though it's not classified here, that's what it's going to be. Sometimes they call that factory burden or indirect manufacturing costs, and you can't specifically identify those costs to a given product. So you see here the examples they have in the bottom. I'll let you read this, but depreciation on plant and buildings, janitorial maintenance labor, supervision we just touched on, material handling, power, and property taxes. Those are all just simple examples of manufacturing overhead. So you have total product cost is the direct material cost plus direct labor plus manufacturing overhead. That's total dollars. And then the bottom, you want to look at it on a per unit basis. Why do you need this? Because you price products on a per unit basis, so you have to know how much it costs you on a per unit basis. I'm not going to spend time going through this a whole lot, but you can see what happens is we're going to calculate a total cost to make 30,000 pairs of jeans. And if you kind of do the math, it says, look, we have 48,000 in direct materials, 30,000 in direct labor, so that's 78,000, another 72 in overhead, so it's 150,000. And they made 30,000 pairs of jeans, so I guarantee you their cost is $5 per pair of jeans. And there it is. So based off of this, you would want to sell your product at greater than $5 per pair, and also they would be carried on inventory at $5 per pair times the number of jeans that are still in inventory that have not been sold. Okay. And you have another way to look at this. You have prime costs, which are direct materials and direct labor. And you have conversion costs is another cut that you might see, which is direct labor plus manufacturing overhead. Just two other definitions. Not that they really are used a lot, but those are other definitions. And I'm not going to spend time going through these calculations with you, but you can look at, I mean, they're pretty simple. You can see their prime costs and their conversion costs. And remember, these are not additive because this one has direct labor goes up here, right? So if you were to just to look at the overhead, it would be 72,000 divided by 30,000 would tell you what the overhead cost is, which is going to be 240, because we know we had $5 a pair. So the sum is, but you can also see the difference in those. Period costs are costs. I can look at a lot of different things, but if I were to look at this, you might say those are really, a lot of times you might call these selling and general administrative costs for the organization. And what they're really saying is no matter what you produce, and it's really going to be like corporate overhead type stuff, no matter what they produce, you can never classify it into inventory. And these are costs that you're going to have no matter how much you produce or no matter what you do, they're going to be there. And when you hear that organizations are laying off management or laying off different people, that's what's in period cost. And you can read through the rest of this and you can see here's kind of the breakdown. Period cost these are all period expenses. So if you're to look at a balance sheet or an income statement, you're going to have sales revenue, cost of goods sold, gross margin or gross profit, and then the period cost will come after that. And you have selling costs are also going to be period costs. And you have administrative costs. These are also period costs that are going to be executive salaries and such, and research and development. Anybody, if you were to think about it, administrative costs are anybody that is not at the manufacturing facility or at the manufacturing plant. And you have direct and indirect period costs that they're going to touch on here just a little bit. Direct would be a chef salary, and indirect would be disposable napkins. And if you look at an income statement, this is what I would call the periodic inventory model. Beginning inventory plus, typically they have net purchases, less direct materials used in production gives you ending inventory of materials. So that's a cost of goods formula as well. And the cost of goods manufactured is direct materials. Um, and this actually is backwards. This formula is wrong. This should be over here, ending materials and inventory. And then whatever the difference is, you're gonna add these two and get a total, and then you're gonna subtract direct materials. It's gonna tell you what you used. So this formula is incorrect. It's gonna be beginning plus net purchases gives you inventory available, less ending inventory, which you physically count, tells you what your direct materials used in production. And that's what this is telling you as well. Calculating direct materials. See this formula? Beginning inventory plus what you bought, less your ending inventory gives you direct materials used in production. So if you could apply this formula to that other slide, which was wrong, you would get correct. Work in process are things, I'm not going to read through all this, but essentially they're things that are not ready to be sold yet, that they're not done completely. They have part of the way done. Picture this, the Jeep that we saw earlier, it's halfway down the production line, it's missing the engine and the seats. That's going to be work in process. It only goes into inventory, final inventory, when you're done. And you can use this to calculate the cost of goods manufactured. And I'll let you read through this and follow these numbers. And it'll tell you exactly what happened. And here's some numbers for that calculation. The direct materials used in production, that's a straightforward calculation. Then you have direct labor, you have manufacturing overhead, and here's the total cost. Here's the beginning WIP and the ending WIP, so the rest is cost of goods manufactured. Cost of goods sold is kind of the same formula. It's beginning inventory plus cost of goods manufactured less ending finished goods inventory gets you cost of goods sold, which is what, and you're comparing that back to revenue, and you're following a principle, an accounting principle called matching when you sell stuff. And here's a calculation for that. I'll let you just follow through. You might want to pause this presentation here to take a look and look at the math, but there's a calculation for that. And it's kind of the same thing. And here's a pictorial of the same kind of stuff. And then step by step by step. So this one gets you cost of goods manufactured, direct materials. You're going to add these other costs, direct labor, manufacturing overhead. You have a cost of goods manufactured that goes into ending inventory, and then it goes to cost of goods sold. So here's kind of a graphical representation of that. And if you're to look at the income statement for a manufacturing firm, sales revenue is price times units sold, because each one of these goes on the income statement. It goes on an invoice to a customer. So if we were looking at blue denim, this is what it would look like. And so here's kind of what their income statement would look like. And you have sales, $8 a pair, cost of goods sold, $4.95, which is the $5 per pair times the 99,000 pairs of jeans that they sold. Then you have gross margin at 297. And then you have the head sales commission, which is 10% of the selling price. That's where this comes from. Fixed selling, that must be sales salaries. And you have administrative stuff, which is going to be like corporate overhead and executives and people that don't have anything to do with sales and don't have anything to do with manufacturing. And so they made $12,800 on sales of $792,000. So this is just an income statement for Blue Denim. And so gross margins equals sales less cost of goods sold. And the other stuff are going to be the selling and administrative. Those are really going to be period costs. And if gross margin is positive, that means that they're contributing to some of their period cost. And that this is wrong as well. It should say period cost. Oh no, this is saying the firm at least charges prices that cover the product cost. So you definitely want to do that. And this is a big number here, gross margin percentage. You can take the gross margin dollars divided by the sales revenue, and that gives you a percentage. And what does that do? It allows you some comparability. And what it says is for each dollar of sales, let's say I had a 40% gross margin percentage. That says for each dollar in sales, I'm delivering 40%, 40 cents to the bottom line. And you can take a look here. Here's just another example on the percentage basis. So here's the gross margin percentage. So it says for each dollar of sales, I'm delivering 37.5 cents to cover my other cost. And it says their gross margin or their percentage operating income is 1.6%. You can see the calculations down here. Operating income, you can see operating income is gross margin less selling and administrative expenses. And then you have the income statement for a service firm. It's going to look very similar. It has the same kind of expenses, but the difference is the income is you're not going to have the cost of goods sold, which is something that we saw earlier in the text, way back in probably chapter 3 or chapter 4. We did mostly service stuff before we got into merchandising in chapter 5. But this is really an income statement for a service company. Notice no cost of goods sold there. Managerial accounting ethical conduct. There's actually an organization called the Institute of Management Accountants, and they have the Code of Professional Conduct, and you need to follow that. And what it really says is you got to do what's proper and right, and you have information that you should not be sharing with people outside of your organization. And in addition to being an ethical conduct as a managerial accountant, you also have conduct that's established by your organization. You have to follow that as well. There's a certification. There's different certifications. The management accounting one is for managerial accountants. That's internal. Certified public accountant is really you're going to work under public accounting, and you're probably going to be in tax or audit. And then you have internal audit. Each one of these certifications is different. I would say this middle one is the gold standard, the CPA. It's the gold standard, but don't think for a minute that you won't want to do one of these others. Depending upon what your circumstance is, my background is actually in certified management accountant, and it's probably better. And you have a certain competence that you have to do, and each one of the exams are different. I can tell you this particular one is 2 exams that are 4 hours long each that you have to pass. And the public accounting has several different sections, and the same for internal audit. And if you're interested in any of these, just look them up. And that's it for this chapter. I look forward to seeing you in the next. I hope you have a great day.